Hello, everybody. Welcome to Friday, the Talk Money with Tom show. We are going to try to help you figure out how to maximize your retirement, especially in the financial aspect. We do that by answering your questions. So you can send those in now. We can try to answer them live. You can go into the chat here on the channel and put in your questions. We'll try to answer them also. You can send them in during the week, and we'll try to answer them. We are not going to be doing a show next week, but we can save them for the week after. So if you want to send in any questions you can think of, I'm sure somebody else will have the same question, right? And so again, this channel was created just because we felt like there needed to be more knowledge, even for our clients in the area of asset management, tax planning and retirement, and basically retirement planning, right? And so lots of resources here. You can go to the channel. There's thousands of videos. You can search through those. You can subscribe to the channel if you haven't done so already, and hit the bell button for new content that's coming out. And we do this for free. We don't make any money doing this per se. It's just something we try to do originally to help the clients, and other people have joined us, which is nice, but nonetheless. And then, of course, if you want to just meet with us, client or not client, we offer a free half-hour, consultation. The book appointment button is there on the website. You can get to the website with the link here on the channel. The button looks just like that. And so set up a 30-minute time with Ethan and I, in the office, on the phone, video, whatever works for you. So look forward to today's show. We've got some good questions and some things that are going on. There's a lot going on right now. It really is. Matter of fact, all year, it seems like there's enough question marks to really talk about some different things. So I do like to start off the show with kind of a summary of what we saw happening in the stock market. So we're going to do something a little different today. We're going to start off with the summary, go through what we saw happening this week, and then Ethan and I are going to do like a little brainstorm, pro and con. What are the things that can maybe make the market continue to go up? What are the things that can stop that momentum and make the market go down, right? So I think that's interesting, because that's kind of how I always look at investing. It's this teeter-totter mentality, or tug-of-war, who's going to win that tug-of-war, and you're basically trying to handicap that contest. And so obviously this is the chart we've been looking at. It goes back to, the late 2018. That initial drop at the very beginning of the chart was the last time we had, tariffs at that time, much smaller than what we have now. Had a nice recovery. Of course, we had the pandemic. We had the big run up after the pandemic, and then inflation hit in 22 and it fell. So here we are now, moving along, hitting new all-time highs. The market is moving very smoothly, actually, and continues to go. And we'll talk about some of the reasons why as far as that goes. But some of the things that were reported this week, which were important, first of all, is a producer price index. So this is wholesale prices. And so if you look at kind of inflation itself, it would start with the increasing commodity prices, and then you would have the ISM survey of manufacturers, and in that survey they ask, are your costs going up, yes or no? And then you would have that come through to the producer's price index here, wholesale, and then theoretically it comes through to CPI, inflation, or PCE is another inflation measure that the Fed looks at, right? So that's the lineage. So actually the producer price index went down for the month. It was month over month, it was down 0.1. Now it was up a lot the month before, up 0.9.
Yeah, it was kind of unexpected that it went down so much.
So between the two, now we're at like 0.4 over the 2 months percent, But you can see on year-over-year basis here, it's a little bit over 2.8%. Again, way off of where we were back in the higher inflationary period, and more or less in range at this point in time. So we're not seeing a huge impact, from tariffs or deportations, at least in this particular report. And then the next report that came out was a consumer price index. Again, this is the core index. That is on a little bit of a rise. If you look, still quite low compared to where it was back in the, 22, 23 time frame, but it's at 3.1%. They always talk about that 2% target that the Fed has. It is on core inflation, and this is core CPI inflation, but they don't mean it on core CPI. They mean it on core PCE. It's always
Yeah, with
important.
PC, there's a little bit lower of a percentage because you're able to do substitutions, while
Yeah.
CPI has a very fixed basket.
Yeah, I think ironically, we'll see what happens here at the end of the month, but I believe at the end of last month, the core CPI, PCE was about the same, year over year, about 3.1%. So nonetheless, kind of going away, we got down into that 2.4, 2.5%, and we're kind of crawling back up. So there is some impact, but it could just be noise, honestly, and it probably is so far. So I think we have some trends that could be developing, worth watching, but it's hard to tell. One of the biggest things that happened was this revision in the monthly jobs number. So this is a chart that actually goes back to 2015, and based on a percentage of the number of jobs that were reported, okay, over the 12-month period. And so what they do is in September they release this for, in this particular case, for the 12 months that ended the end of March 2025, right? So it's 6 months later, they've been able to get more information and tighten up the numbers, and they dropped 911,000 jobs.
It's a big number.
It's a big number, and as a percentage, it's actually a little over 90% of the jobs that were reported weren't actually there in the end. Last time, you can see the other red bar right next to that is last year. It was 800,000 jobs. And so, you can see, and actually in 2019, that was a 98% reduction in the jobs, and some of those big up ones. So it's not a clean report by any stretch of imagination. Every time they make this adjustment, sometimes it's quite large. However, it did create a situation, and I think this is important, with CPI being, within expectations, with the job numbers being revised down, the other actual current job reports being fairly weak. It really stimulated the market in the concept of having this rate cut, right? And so that's all week I've been reporting essentially bad news about the labor market, and the stock market has continued to go up on all of those reports, right? This is where that bad news is good news, right? As far as that goes. So we'll talk about what that means and kind of where bad news can become bad news. Yeah, right? And so this is the other thing that came out. This is initial claims for unemployment. So this is done every week. How many people have had their first time claim for unemployment this week? And so it went to 263,000, which is actually the highest we've seen since the 2020 big downturn, right? Lots of unemployment claims because people are closing businesses. And so, again, that made the market happy because, again, softer labor market means that you've got a situation where the Fed is more likely to cut rates more times.
Yeah, and the dramatic spike was a lot of people were attributing it to the Texas floods, where a lot of people were starting to claim benefits from that.
Yeah, that makes sense. Yeah, there's a bunch of businesses, I'm sure, that were wiped out there and what have you, too. So, yeah, and so, we'll see how that plays out. To me, so far, what we're seeing is, I will say, if you look closely at this chart, it was kind of bottoming out at January 24. We've got a lot of purple after that. So we got a fair amount of job weakness that's happening, and not just this year, but even starting last year. I think that's one of the things that we're seeing is, in general, that the trend for this didn't start with, this current administration even. It started, at the end of last year, or at the beginning of last year, for that matter. So here's something that I think is important. So the market gets really excited about rate cuts. And that's because 80% of the time, 12 months after a rate cut, the market is up. And so the study that we just looked at said 4.9% to 14.1% is kind of the range after a rate cut for how much the market is up. So think about that. If you're a betting person and you got an 8 out of 10 chance, you're going to bet on that, on a regular basis. And that's why money comes in when rates go down, period. It always does. Now, it doesn't always work. The other 2 out of 10 times can be fairly dramatic. And so, for example, here's some cycles where it was negative 12 months later. So 1973, it was down 36%. That was the oil crisis and recession, right? 1981, 12 months later, it was down 17.8. We had high inflation, something we could get here, and recession. 2001, dot-com crash and recession, that's down 14.9. 2007, financial crisis, recession, down 27.2. So what's important about all of those is recession.
Yeah.
The word recession, it's in every one of them.
Yeah. The rate cuts don't save the economy if they're in recession.
Yeah, exactly. So that's where the Federal Reserve, something happened that was dramatic and not known, like we actually saw in the financial crisis, or you could take rate cuts to zero, like they did at the end of the 2000 downturn, the end of the 2008 downturn. Still not enough. It's still the economy's still spiraling down, and so oftentimes, actually, what they did in 2008, rates are already at zero, so they started pumping money out in all of these little bailout forms, sending out actual checks to people. And, it worked. It actually got us out. Same thing we did in 2020. Rates went to zero after the pandemic, but they pumped out a ton of money. And in hindsight, probably too much. Things went nuts after that. So it is important to realize that rate cuts are good unless you're heading for a recession. And so that's kind of the concern about, what might be coming at us, because some of the negatives, which we'll talk about here in a minute, and the pros and cons, have that capability of creating a recession, even a really large one. So we'll talk about what that means. But that's where I think you have to take it with a grain of salt when they're cutting rates. Usually they're doing it because something's falling apart. 8 times out of 10, they're able to do it and things turn around, right? And there isn't a recession to really deal with. So hopefully we're in that 8 out of 10, but we have to be careful of when these happen. And the last one was 2007. That was a while ago, and we've had a nice run up. We've got the first or second most expensive market, depending on the measure you're looking at, in history, going back to the 1800s. So you're more likely to have pullbacks when things are stretched out this far. And so then here's something that I think is very interesting. The reports that are coming from the government right now are the reports that you would want to see if you were hoping for more rate cuts. So in other words, if you're going to do a jobs revision report, you'd like it to be higher, not lower. So it was the highest we've seen in a number, 911,000 revision. And so we got higher. We would like to see lower inflation. We got lower inflation on the wholesale. We got lower inflation, at least expected inflation on CPI, right? And so the problem is that these numbers are coming directly from the government. And the last person that was in charge of those numbers got fired. And so and this is just something, no matter what your political persuasion, the concern would be in that scenario is the new person, running the Bureau of Labor Statistics, is that person going to put out bad numbers, right? Or the numbers that, in this particular case, actually employment growth would have been bad if you're hoping for rate cuts, which is what Trump's been talking about the most. So are the numbers going in line with making those rate cuts? And so it could be exactly accurate, but there's going to be a continuous suspicion because the last person got fired. And does the next person want to get fired? Probably not. Does that mean that they want to produce the numbers that will keep them employed? Maybe. That's a problem. So what do we look at, right? Well, first of all, this is the ADP report. So this comes out, really just before the big jobs report that comes from the
it's usually the day before.
Yeah, the Bureau of Labor Statistics. Now, this is private payroll. Doesn't include public companies or government jobs. But it is something that is not produced by the government. This is actually done by the ADP, which is a big payroll service, right? And so, you can look at this. This is going back to 2010. You can see the big drop that happened during the pandemic. But it's still going up, actually. So it's kind of interesting. On a private payroll standpoint, we're still seeing, continued growth. I would say it's flattening out there if we look closely at the end of that curve. So that's something we can watch and maybe feel more confident, at least as a check against what we're seeing from these government numbers. All right. And here's another thing, which is just commodity prices. So this is the year-to-date commodity price index through iShares. GSG is the ticker symbol. And, it's definitely on an uptrend, no doubt. However, really that uptrend so far has really been recovery. Okay, so this is a basket of different commodities. This is one of the first things you would see moving up if you expected inflation to come through or even the tariffs to have an impact, is in this particular category. We have 50% tariffs on aluminum, copper, steel, etc. And we're seeing an increase. The trend is definitely up. However, if you look closely at that, we're really just back to where we were before the Liberation Day in April. So we've just recovered. So I think it's more important what's going to happen with this going forwards. Okay, but again, this is not something that the government can control. This is actually a representation of what's happening in that market, right, with those particular commodities. So that's something to watch if you're a little bit worried about what's being produced. And then maybe the last thing here is just earnings. So the orange line is the earnings for the S&P 500 per share, and the blue line is the actual S&P 500. You can see the correlation there. But the earnings you can see it's flat right where it is right now. That's mainly because we haven't had a lot of earnings reports. And so it does flatten out once in a while while we're waiting. But overall, the earnings are still up, right? So, but we want to watch those earnings. Do they start to have problems? We want to watch that commodity thing to see for inflation. We can watch the private payrolls to see if there's deterioration there. All of those things are not controlled by the government, and these are all, earnings are reported by companies directly under pretty strict regulations, et cetera. So these are the things that, we would be watching as far as that goes. And so anyway, that's kind of the summary portion, and let's just talk about a little bit of pros and cons. So what are some of the things that we can think of why the market would go up, okay?
So consumer spending is still resilient. Consumers are still going out and purchasing things. Labor productivity is up too in the last quarter. So even though labor market's doing less, you're still producing the same amount.
Yeah, and that's maybe one of the biggest drivers is artificial intelligence and the spending on artificial intelligence, and perhaps productivity has picked up there because of, hey, we can do this with 3 people instead of 4 because we're employing, an artificial intelligence in that particular group, and they're getting more done, right?
Yeah, and then having that anticipated rate cuts and multiple rate cuts at that really drives the stock market well.
Yeah, and I would say that we can throw in the big beautiful bill as one of the stimulants to the stock market for a couple of reasons. Number one, it gave some clarity on what taxes were going to be, because otherwise there would be none. It was supposed to sunset all of the tax rates and what have you, especially on the consumer side, and that's now extended out. There's some potential cuts in there for different types of people with different credits that they included, which is, again, stimulative. But the one thing that I think is the most interesting is the bill is supposed to produce about $3.3 trillion of deficit, according to the Congressional Budget Office, over a 10-year period. But if you look at it, actually the deficit is higher on average at the very beginning of the bill, because they're spending the money, in this case like Homeland Security and building detention centers or whatever they might be doing, but they're not saving the money like with the Medicare cuts and some of those other types of things. They delayed those until after the midterm. So that means positive cash flow is coming out of the government. Government spending is a stimulative to the economy, right? It just is. So I think the whole thing revolves around the AI trade. If AI turns out to be something that isn't what everybody's hoping it is, market would probably fall like tomorrow, just because that is the main driver of the whole thing as far as that goes. What are some of the other reasons the market could go up? I think that's the majority of them. I would say regulations and maybe continued deregulation. So we've seen some deregulation of some of the banking pieces. Most of what's happened in banking means that they don't have to have as much capital on hand, which just means that capital can get out and start moving and maybe stimulate the economy.
You could say trade deals, even though trade deals are kind of negative in there's a cost to them. They provide certainty, and then that certainty allows business to invest, and then being able to have that certainty allows them to grow.
Yeah, the market seems to have really calmed down about the whole, tariff situation, and maybe even more so now that there are a majority of them seem to be more or less settled. I know China was just kicked down the road another, whatever, it's 30 to 90 days. I think it was 90 days to November 10th.
Yeah.
And so, that's okay. At least there's something there. Lots of threats being thrown around, like, hey, you should, Europe should do 100% tariffs on India and Russia because they're still using Russian oil.
Yeah.
Not India, Russia, India and
In
China.
China.
Yeah, because they're still using Russian oil. So, okay, so I think that's the majority. I think the deregulation, yeah, that's a good piece. All right, so then the other side, of course, will be, the tariffs are at the top of that list. Tariffs historically at these levels have been pretty disastrous. And sort of as a pro, they also don't stay there historically at these levels. They come back down, which you could say is a good thing. If that does happen, if it's just temporary at this level and it comes back down pretty dramatically, market could sail right over that.
Yeah,
But
the one problem with that is the legality of the tariffs now cause a lot of people just to wait.
Yep.
Can I wait 3 months and know have for certain there's going to be tariffs or no tariffs?
Right.
I'm not going to do anything for those 3 months then.
That's right. I would think it completely weakens the negotiating point that we have, or power that we have, because a lot of these have already been determined. But whatever's out there that might be moving forward in terms of doing negotiations, if I'm on the other side of Trump here, I'm slow walking things because maybe they go away, and I even get a refund of the tariff that I've paid in the past. So I think it's quite possible that the Supreme Court does side with the two lower court decisions, because it's really hard not to, but it's not impossible in this environment to see the Supreme Court decide that these tariffs are okay or give that power to the president forever, which is kind of interesting. So it's a big precedent-setting case. However, they also have other ways to get tariffs. So I think tariffs are still a problem at the level that they're at. If they start doing line item tariffs instead of these emergency tariffs, the tariff semiconductors and pharmaceuticals and all these other types of things, those could be pretty high. And it's hard. There's not a country that's going to complain about it per se, like there is in this direct country to country. If it's just pharmaceuticals, then it's these pharmaceutical companies, which, I don't know, they have good lobbyists, so who knows. But nonetheless, and so I think the other, obviously, thing is deportations. So I saw something, we're going to have the slowest growth in population in 2025 that we've had in a really, really long time. And growth in population has a direct correlation to growth in the gross domestic product. So when you shrink or slowly grow the growth because of deportations, that's a piece. And then obviously the biggest impact of that is the potential for lack of labor in certain industries, whether it's construction or the, restaurant, hotel industry, or, agriculture, or the meat processing plants, or whatever it might be, or trying to build a battery plant in Georgia. If we ship all these people out that can do these jobs, either because their expertise is something we don't have currently and we need to learn, or because they're doing a job that nobody really wants to do here. I don't see a bunch of Americans running out to get jobs in the fields. It's a really brutal job. And so anyway, that, and I would suppose that in order to get those people out, they're actually going to have to pay more. So that has inflationary potential. And we are seeing some of that already.
You can see the reacceleration of the inflation now.
Yeah, in the food. So they are trying to do some things to try to, like I saw an article talking about coffee has gone up 21%, and they're talking about making an exemption for coffee because we really can't grow coffee here at any great level at all. And so, and that's going to hit that consumer right in the face and that voter right in the face every time they're going to get their coffee. And generally, I would bet that people know what their coffee costs. And if it jumps up a bunch, they're gonna know. And they're going to know who to blame here. There's actually some other reasons why coffee might go up, but I guarantee you they'll be talking about tariffs, not lack of rain or whatever it might be that also contributes. And then, of course, we've got the independence of the Fed is being really attacked here altogether. And if it's successful and the Federal Reserve becomes political, that is not a good thing for the stock market. No, the Fed needs to be able to be independent and make those decisions based on sound economic policies. They're not good at it. Nobody's good at it. No, they're not. They're late. They're early. They're not right on time. However, if you just get in there and say, "Hey, we're going to reduce them 2 or 3%," right away, I'll bet you that you get the exact opposite of what they want out of that. I bet you the other bond, because the Fed only reduces the shortest terms of the market, and the market has to respond to that. I think with the Fed being politicized, the market's going to want to be paid more, the bond market, for longer term treasuries, which is where mortgages sit.
Yeah, people look for, or investors look for stability. Having a politicized Fed is not stable because you're gonna try and overheat the or you're trying to grow the economy always, and so
Yeah.
you could probably overheat. You could be throwing too much fuel into the fire.
Yeah, exactly. So that's kind of it's the tug of war, does the AI and the productivity and the lower interest rates and the, tax situation being solidified, lower regulations, does that outdo, the tariffs, the deportations, the independence of the Fed? Those are the big ones, certainly, in my
Yeah.
opinion. And so when we look at like what happened in 2000, I said this last week, but I think it's important. 95 to 2000, we had a lot of those same positives, especially the .com, which was exciting, biggest driver in my opinion. And that's the biggest driver now, which is the AI, which is exciting, right? And there's money pouring into that. However, in that time frame from 95 to 2000, we did not have a, you know, tariffs. We didn't have mass deportations that are scaring people from going to work. We didn't have this independence of the Fed being challenged. So those are things that are headwinds that are going to make it so that we can't really complete that big 5-year run that we probably would have had.
Yeah, another thing to think about is also I think that was one of the few periods that also the U.S. government was running a surplus.
Yes, that's right. There was a period in there. It's the only period that I can remember in my lifetime, actually, where we were running a surplus. And so, it was working really well. And I guess that's something we didn't talk about and we should be talking about is the actual debt load, because the big, beautiful bill is a positive on one side, but it's also a negative on the other, because it's going to, in its own structure, it's going to create a higher deficit, right? And the bond market's already at 37 trillion, and the interest is growing because rates are higher. And Ray Dalio, who's one of the big hedge fund managers, who's running around talking about a debt heart attack, right? And basically what he's saying is that the load of the debt will continue to get bigger, and the interest rate will start to eat up more and more of the
It's gonna
overall
spiral,
budget.
basically.
Yeah, and that means they got to borrow more, right? So that's the spiraling, level. I would say that probably takes more time than some of these other things, but it's hard to say. I mean, if you really start messing with the Fed and rates go crazy on one end, you could create more problems pretty quickly there. We'll see how that goes, but that's another one that's on the other side. So anyway, hopefully that helps a little bit to understand. Again, we're 2/3 in, 1/3 out of our normal allocation in stocks, based on this pro and con kind of teeter-totter, tug of war situation. There's enough things tugging on the negative side to say, okay, we don't want to be 100% in. If you took, those three big things out, with the tariffs, deportations, and the Fed piece, we'd be 100% in. So it's just a matter of seeing how those play out. I will say that one thing to keep in mind is those big negative things, they could go away really quickly. If I don't know that they would, but in theory, tariffs could be lowered by Trump, like tomorrow, next month, whenever there's problems. He could bring that down. He could carve out all kinds of line item things on places where we're having trouble. So, and they've done that actually to a large degree. It's a matter of being able to do that before something breaks, but that's possible. It's also possible that they change the deportation picture, just at least in the sense of being able to, because Howard Lutnick said, hey, the South Koreans should have come to me for the visas. Well, we shouldn't have to go to Howard Lutnick to get the visas. There should be to keep that plant. They're building that plant. They had 300 South Koreans there. And it strikes me that we just need a program that is efficient, that works. And my gut feel is that they're slow walking any visa stuff because they don't want anybody in the country, even if we need them in the country like we did for this. And so that probably just backfired as far as that goes. But that could change, right? That could be something that gets improved dramatically, helping the farmers, right, bringing in people, helping the meatpacking plants. So they could do that. Now there's a push to do the opposite, which is just to remove everybody who basically isn't white for the most part. However, it could change. And then, of course, the Fed piece, it could change also. They could back off on the criticism and whatnot. So that makes that handicapping even harder. You could make an argument that maybe all of these negative things just disappear and don't cause any real problems. And that's basically the argument the market's making right now, hitting new all-time highs. So, I will say that these things do take time to have impact. I've read several articles. Oh, the tariffs have no impact. Well, wait a minute. Let's wait a while to see, because the studies are showing that 15% of the tariff is being paid by the exporting company or country or mixture thereof. 15% is being paid by the consumer, and 70% is being paid by the company, the importer. So that's why we're not seeing big impact on price. But the expectation is that's going to reverse. It's going to be 15% that the company absorbs and 70% that the consumer absorbs. I'm rounding from what this study said, but it's you get the idea. So anyway, that's what's happening this week. Again, lots to talk about, lots of things that are very, very interesting that are happening right now and how that has an impact. But I look forward to being able to cover that again, here in the future. So let's switch over to our first question.
So, bad news is good news right now, but what would cause bad news to be bad news again?
Yeah, let's go back to that slide because that's pretty good. Here. So, lowering of interest rates is a good thing 8 out of 10 times.
Yep.
So, what makes interest rates go down? Well, they have a dual mandate. Inflation, so if inflation's coming down, they can lower rates. If unemployment is going up and the job market's getting weak, they're going to lower rates. So sometimes it doesn't work because there's too much coming at us, and so that's where bad news becomes bad news. So when they say, hey, we just revised the jobs down 911,000, 90% of the jobs that we reported over the last 12 months are actually not there. That's bad news that could be bad news if it continues, right?
Yep.
So if you continue to see an acceleration of problems in the job market, the Fed could be far enough behind on that because of their worry about inflation from the tariffs that it spirals down faster, and we've seen that twice now. They go to zero, the market's still falling.
Yeah,
right?
The market doesn't matter.
Yeah, because at some point in time, you're at zero. Now, what are we doing now? There's still layoffs happening. There's still this cycle. And so you can get into a cycle on either side, and there is a negative cycle that happens and so these are examples of where the bad news turned out to be bad news. I mean, I guarantee you the rates were going up before. I mean, the market was probably going up at the beginning of these cycles. Matter of fact, I know in 2007, the market didn't peak until October. And even though they were starting to see more and more deterioration, the market continued to go up for quite a while. And then eventually, it bottomed out in 2009 in March. So, and 57% lower in total from high to low. So anyway, I'd say that's the best answer of that. It's just a matter of right now it is still good news, because the market is okay. The unemployment's at 4.3%. That's not terrible. It's the highest it's been since 2020, but it's still
It's
number
still
itself.
the range that the Fed
Right.
finds acceptable.
Yeah, it's not a bad number. You worry about the trend, right? I mean, that's kind of what you're looking at. We're going in a particular direction. Does that stop or not? And you kind of assume it's going to keep going. We saw commodity prices are going up since April. Well, but they're back to where they were before April. So, how are you looking at that? Commodity prices are going up, or we just returned back to the average?
Yeah, and there's commodity prices going up because there's going to be more demand, because there's expectation of growth.
Right.
What's driving those?
Yeah. Now, if we continue to see that trend line go up and up and up and up, we'll have some indications of what's going on, irregardless of what the government says about inflation or what have you. It'll be a good thing to look at. So, yeah. Anyway, that's a good question.
So, with the expectation of rate cuts coming up, would now be the time to invest into longer-term bonds and CDs?
Yeah, with one caveat. So there's what happened the last time that this happened. The last time we had big inflation was in the 70s. And really late 60s to very early 80s in that time frame, 69 to 81. And so we had this big jump in inflation. They raised rates to bring, and then the unemployment started to get higher. The job market started to get soft.
Yep.
Sounds like what we're doing right now. And so they started to lower rates. And then inflation got out of control to the upside. And they had to raise rates. I mean, the Fed fund rates right now is what, at 4.5, basically 4.25 to 4.5.
Yep.
And they were at 19% in 1980, I believe, or 79. Can't remember where that peak was. But so that's what they had to do to fight that. And so here we are with these tariffs, deportations, both of which are potentially inflationary. And so it'll be interesting to see. So I wouldn't go super long, just because there's a chance, CDs, we'll talk about CDs first, because they don't drop in value. If rates start to go up, you just want to get the next CD to capture that higher rate. So if you're in there for a year or two and rates go up, when it comes due, you can jump that up. If you're in there for 5 years or more,
You're locked in.
you're kind of locked in. I wouldn't be locked in that long, personally, just because there's this possibility that rates go up. However, you want to lock in long enough. That's why like a year to 2 years does make some sense, because if that doesn't happen, rates are probably going to continue to go down, and you'll be pretty happy that you've got that rate that you got today. So that's kind of how I do the middle ground. So in terms of the bonds, they're a little different because they can fluctuate in value depending on how long they are. Like the T-bills ETFs that we buy, they really don't fluctuate in value. They kind of go up daily for all intents and purposes. And versus, say, a longer-term bond fund, I'd probably stick and still in that kind of shortish area of the bond market, just because the picture for where rates are going to go is still vague, in my opinion, because it really depends on what happens with some. I mean, you could see rates go up because we're having to refund these tariffs, because the market has bought into that money coming in, and the bond market has said, hey, we don't have to pay for. They're talking about $30 billion in August, right? So $30 billion came in from tariffs. That means $30 billion of bonds did not have to be issued, right? They could theoretically, if they're using it, they could use that to fund the deficit.
It's kind of like a double whammy when you have to refund it.
Yeah, you have to refund it, which will probably be a consolidation of months altogether. Maybe they can stretch the refunds out, but that's a lot of money going out. They said if it's delayed until June, which it doesn't sound like it will be, but there's a $1 trillion refund. That's a lot of money to come up with in the bond market. And the bond market probably freak out on that. So they're trying to get it done by the end of the year. I think they'll probably do that. But even then, we've been doing tariffs theoretically since February, and a lot of those tariffs, 78% of the tariffs we've done so far are this emergency tariff order. And so, again, that's been deemed illegal twice, because the order doesn't actually say they can do tariffs. So you can regulate imports. All right, that's different than actually taxing imports.
It's like the shipping of chips out into the country. They can control what goes out.
Right, exactly. So, yeah, that's a good question. What else we got?
What is recasting a mortgage, and what are the pros and cons of that?
So recasting a mortgage, for example, let's say you got some money that came in, an inheritance or whatever it is, and so you've got this lump sum, and you've got a fixed mortgage, or at least a fixed period. You can have 7 years fixed, and then it goes variable, or whatever. It can be 30 years fixed, 15 years. So one of the problems with dumping a bunch of money into the mortgage is if you don't recast it, nothing really changes.
Yeah, you still have the same mortgage payment, but you save interest because you'll pay off sooner.
Yeah, the big advantage of that is you put that chunk into your mortgage. It won't affect anything. It won't help anything today, okay? Because you're still going to have the same payment. But more of that payment's going to be going towards principal now, because you've just reduced the principal. So you're going to pay it off faster, right? So eventually there's a pretty nice payoff. However, another way to do that, if you want to pay off today because you need to reduce your payment, let's say, for example.
Yeah, recasting is basically you put a lump sum into your mortgage, and then the loan provider will basically kind of amortized based on the new principal amount. So like it'll keep the same loan terms. So your interest rate will stay the same. Your due dates will stay the same. The only thing that changes is your monthly payment.
Yeah, so it's a nice way to go. You don't have to go through a whole refinance again.
Yeah,
Maybe
so
pay fees or
you'll
whatever.
have some fees, but they
Right.
typically aren't too
Small.
expensive.
Yep.
You don't have to do any kind of credit checks. The loan term it stays the same. Um, if you have PMI, you potentially could have enough of that equity that you don't need PMI anymore. So that could be a savings of that.
What's PMI?
Uh, or private mortgage insurance.
Yeah. So, not everybody has that, but if you have, usually if you don't put down at least 20%,
Yeah,
you end
anything
up
below
with
20%. So
private mortgage insurance,
especially for
which can be expensive.
yeah, especially for younger owners, a lot of times they put 5-10% down
Right.
just to get in.
So let's say your lump sum is able to get you down to that 20% level or better, and it would get rid of that private mortgage insurance. So,
Yeah, some of the negatives is you're not changing the interest rate. So like
Right.
if you have a good interest rate,
right.
if you're in the 3%, should you be putting the money into the mortgage? Because you're really locking up this money into your
Right.
home equity.
Right.
And the only way to get back out is you sell the house or you have to take a home equity loan.
Yeah. Well,
So-
you pay it off earlier, so you sort of get it off. I pay it off 12 to 36 months before I would have. I get my payback
Yeah,
in that
the-
time frame, right, at the very end of the loan.
Well, that you won't have that with the recasting because you
Right.
you keep the same terms.
Right.
So you only saving by having a lower outflow basically each month.
Yeah, yeah, exactly. So it's an interesting thing. You were telling me there's a minimum usually that these banks have. Not everybody will do it either. It depends on your
so-
loan.
Yeah, you have to check with your loan provider.
Right.
There'll have to be some amount. Some say goes as low as 5,000, a lump sum of $5,000, and
Yeah.
they'll recast it. But I assume it has to also depend on your property value too. What
Yeah.
you want to do.
I would assume the banks are going to want to see more coming in to make the effort to do it, but nonetheless, it's an interesting thing. It's one thing to look at, especially if you happen to have a higher rate, and then now people have higher rates, that have
Yeah,
bought.
if you're in the 5-6%, recasting is you get your returns and essentially having a lower payment or each
Mm-hmm.
month you have is that kind of return of that principal in a sense.
Yeah, theoretically, you could take a look at that, and you might be making a pretty healthy return on that investment in terms of reduction of payment. At least from a cash flow standpoint, you get a lot back. So I could go buy a dividend-paying stock that pays 7%, or I could dump that money into my mortgage and reduce my payment by the effectively 7%.
Mhm.
And the dividend-paying stock is not a bad
It fluctuates.
It's
It's
not a bad
guaranteed.
solution, but it does have some disadvantage. It fluctuates. They could change the dividends,
Yeah.
right? You could lose 20% on the price and get 7% dividend and actually be under.
Yeah.
Or it's more guaranteed in the mortgage. It's just the payoff is just different.
Yeah, and recasting, if you keep your old payment, let's just say, hey,
Right.
I'm going to keep doing my same old payment, you'd pay off that loan faster.
right.
It also gives you a little flexibility too, saying 1 month, hey, I was stretched a little thin, I might be able to just do the minimum payment rather
Yeah,
than doing the old.
that's right. Gives you some wiggle room in case things go south financially for you for whatever reason. Okay. Well, that's our show today. Again, we won't be here next Friday, but we'll be here the Friday after that. What is that? The 26th, I believe.
Yeah, 26.
So not here the 19th, but we'll be back on the 26th. Not sure I'll be able to do a summary on the 19th actually, but I'll try. And we'll look forward to being able to see you again. Again, send in your questions. Ask Tom, talkmoneywithtom.com. Go to our channel and subscribe if you haven't already. Hit the bell button. And then, of course, if you want to meet with Ethan and I, we're available for, a 30-minute appointment. Go to our website, hit the book appointment button, and schedule something that works for you. So look forward to being able to talk to you again on Monday. I'll do the normal, what happened in the market video. So look forward to talking to you then. Thank you very much.